everywhere there is uncertainty. People have booked profit or booked losses, they are in the liquid state. The money is idle sitting in the account, either looking at some small returns on FD, so that there is a safety on the investment, at the same time get some return. But is there any opportunity where there is safety but we get a return better than fixed deposit? Because investing in gold in the current scenario, because it has gone up a lot, it's really expensive right now to invest in gold, and in the short to medium term it may not be the right opportunity to put money in gold. That's what the current rise in gold prices are suggesting. Stock markets are falling. The more you buy, the more the prices are falling, which is what we are looking worldwide. So now, where is that opportunity to invest? That is a safe fixed deposit. But fixed deposit in the short term gives lower interest rate than the interest rate for a long term. So what do we do with this money where we can get better than fixed deposit, but at the same time it should have a very decent, a very great safety like fixed deposit? The solution is to put in debt funds. So mutual funds are not just only for the equity investments. Equity mutual funds like large cap funds and sectoral funds, mid cap funds, all those things, right? But on the debt side also we have mutual funds. So debt mutual funds will give better returns than fixed deposit, even if you invest for short term. Debt funds doesn't have to be always for long term, it can be even for the short term. There are some ultra short term also, or liquid funds where these funds are for 1 day 2 day also. Smart investors, what they do is, on Fridays they put into a debt fund, on Monday again they redeem from the debt fund. For 2 days also some sort of better interest is also generated by investing in those funds. Now, all those who have exited from the stocks because of the losses or because of the profits, whose money is idle and no better opportunity or great opportunity to invest for the next few days, few weeks, few months, for them the ideal solution is always a debt mutual funds. So these debt mutual funds, what they do is, they not just invest in government securities or fixed deposits, they also put in corporate bonds and other securities where it's a debt related instruments. There are every mutual fund has got debt funds. So these debt funds are performing better, especially the short term duration debt funds are also available in the mutual funds. So why don't we look at those things and look at the and appreciate, and also if possible try to find out if there is a great opportunity and invest in those funds, so that at the end the objective is to get better return than fixed deposit, even if you invest for very short period of maybe few days, few weeks, or few months. So let's come and see one of the fund what I was going through is Axis Mutual Fund. Now Axis Mutual Fund, Axis Short Duration Mutual Fund, this is a fund which started about 15 years ago. And if you see this particular fund, this also has a SIP which is 1000 rupees per month, and minimum investment is 5000 rupees. And if you see the historical performance of this particular debt fund, since inception this fund has given 7.5% return. Last 1 year it's given 7.8% return. And those who have put money for just 1 month in this particular fund, they have got a return 7.45% on a yearly basis, right? So if you put for 1 month, proportionately the interest will be paid, calculating 7.45% per annum basis. So that's how even for 1 month you can get better return on a debt mutual fund than a fixed deposit. Now we can also do a comparative here. If you see Axis Short Duration Fund, ICICI Pru Short Term Fund, Kotak Bond Fund, HDFC Fund, SBI, and Bandhan Bond Fund. Now if you see the performance of 1 year, the best performance has been HDFC Short Term Fund, and for 2 years also 7.86% per annum return is what HDFC Short Term Fund is showing, whereas Axis Fund is showing 7.54%. Now if you see, there is a variation in the performance of each and every fund. One of the reasons for the variation is how best the fund is handled, what best what do you call debt instruments these funds have invested. That makes the difference in the performance, because if you are putting money in a little higher risk, that is, all debt funds, debt instruments will have credit rating. If the risk is higher, the interest rate also will be higher. So if the credit rating, that is the credit risk, goes higher for a particular debt instrument, the interest rate will be higher. Just like imagine if your credit score, if your credit score, CIBIL score, right? We call CIBIL score for an individual. If the CIBIL score is not so great, we say, is it above 800 or is it above below 800? If the CIBIL score is above 800, if we go for loan, our interest rate, the bank's charge will be less. Whereas if our credit score or CIBIL score is less than 800, then the interest rate charged for the loan given to us by a bank will be higher. Similarly, in this also, depending on the debt fund, whatever is the rating given to them, the return also will be accordingly better or lower depending on the credit risk involved in that particular debt instrument. So if HDFC fund is getting little higher than Axis, that means not only that they are managing well, but also they'll all maybe putting little money in a little lower rating debt instrument. Doesn't mean that there'll be high risk, there'll be not so high risk, but decent returns can be expected by taking slightly higher risk, or putting more money into a little lesser rating debt instrument. So it is always safe to take a second level or third level sort of fund, which can be more suggestible because the risk level will be low. The objective is the fund should be as safe as fixed deposit, but get better return than fixed deposit, that too in the short term. So three points: safety for the investment, best return, and for short period. So all these three put together, we need to look at low risk, better rating fund, better rating instruments fund, where these funds are trying to get maximum profit and better than the fixed deposit. So I am looking at Axis short duration fund. The best performer has been HDFC short term debt fund, and the next best is ICICI Pru short term in the course of 1 year. But if you see in the course of 5 years, the best performing is ICICI Pru, which has given 6.66% per annum, whereas for 3 years it is again ICICI, again here 6.86%. So if you see the longer term, ICICI is definitely maintaining the leading position in all these funds. This is what the data is suggesting to us. Now if you see where this fund has invested this particular money, if you see here, NABARD, that is the National Bank for Agricultural and Rural Development, which is giving a 7.5% return on the debt instrument. Again we have India Grid Trust, which is giving 7.87% interest. Then we have Bharti Telecom. If you see this is a public limited Bharti. We all know that Bharti Telecom belongs to Bharti Airtel, and Bharti is a limited listed company. This particular telecom, the debt or the fund they are offering is 8.95% is the debt instrument they are offering here. So these fund people have invested in this, so this is getting a higher interest on this, maybe because the credit rating is definitely will not be as good as NABARD. That's why if you see NABARD has got 7.5% because it's got a very good credit rating, whereas Bharti Telecom will definitely not have credit rating like NABARD. That's why the interest they are offering is at 8.95. Just imagine, when the credit rating is very good, when we have confidence, even if the interest rate is lower, we go and put it here. And these people also can command a better interest rate because of the credibility and the low credit risk, or what do you call liquidity. All those issues will not be there in this NABARD. That's why the interest rate is lower in this case, whereas in Bharti Telecom it is higher. So if you see the credit rating, these instruments will have AAA, or AA plus, AA minus, like that. If you see in this, in January 2025, 58.4% of the portfolio seems to be invested in AAA rating debt instruments. Again, if you see the next highest in sovereign bonds, 26.56%, and in 12.8% of the portfolio is there in AA, AA minus, and AA plus credit rating instruments. So this is how these funds can be looked at, and to invest in these funds, do this research and find out the best performing fund. One can use Funds Bazaar platform, where you can do research not only on the debt funds but also on the equity funds. You can open a free account on fundsbazaar.com. It's a listed company, and they are providing their national distributor for all the mutual funds, insurance, whatever you speak about in the financial services, financial instruments. All those instruments are provided on the same platform, on a single platform. Whole of the family can have one login, and all of the family members can separately invest in different financial instruments in this particular platform. There is an app also, Funds Bazaar app. You can look at it. I'll just share the link. You can open an account, do your research, and make your investments through your net banking process, and find your portfolio performance on single platform for a whole family. Happy investments. Thank you.